Nintendo is a wonderful business. They have some of the best IP in the world, if not the best, with Mario and Pokemon and Zelda. But what you don't get from a qualitative analysis is the numerical side of it, obviously. You have to dig into the financial statements in order to get a sense of how good of a business Nintendo is and what separates it quantitatively from its peers. So before we get into it, my name's Christian. I'm a CPA and senior financial analyst. And in this video, we're going to do a deep dive on Nintendo's financial statements to try to put some numbers to how good Nintendo is, especially compared to the competition. And I think some of the numbers will surprise you. So let's just jump into it. Okay, the first question we want to ask is, what do the financial statements tell us about the business and about management? So in the last video, we did look at the gross margin quite a bit, and we're not going to go into that here. What we're going to look at is the bottom part of the P&L, which is the costs that go into operating the business. And I think to just get everybody up to speed here, what we notice right away looking at the historical SG&A to revenue is the inverse of the console cycle that we see in the sales and the margin side of things. When Nintendo releases a new console, you typically see worse performance in those years in the free cash flow and in the operating margin because there's so much hardware in the sales mix, which is a lower margin product versus the games. And then in the mid-cycle years, Nintendo makes all their money. And we see exactly that from a cost perspective, looking at the SG&A, where in the year that they launched the Switch 1, they had these higher SG&A costs. Usually that's due to maybe increased marketing, increased R&D is potentially a factor. As we saw in the last video, Nintendo expenses a lot of their R&D costs instead of capitalizing them because they report under Japanese GAAP. And then in the launch of the Switch 2 years, they had a very similar situation. However, in the interim years, their SG&A drops and is honestly very stable. I think that's important to point out. Nintendo's management seems very capable of managing costs and very aware of it. And that is definitely what you want to see in a management group if you're going to trust them with your capital. I think the other thing to point out here is that from fiscal 18, when their SG&A to revenue was about 15%, up to the years surrounding the Switch 2 release, it only grew about 1.5% to 2%, which is quite a bit less than their operating margins increased, which shows that they have operating leverage during the mid-cycle. The other thing we see when we dive deep into the income statement is the absolute privilege that Nintendo has when it comes to advertising and marketing. Because of their loyal user base that gets so excited about their games and about their consoles, their marketing spend is so much lower, even in a console launch year when they have to ramp up and try to communicate that a new console is on the way, is so much lower than the competitors. This is versus EA, which itself has very strong franchises, and Take-Two, which is the developer of Red Dead Redemption and Grand Theft Auto. For example, when Nintendo released the Super Mario Odyssey trailer 9 years ago, it got 60 million views on YouTube. That is them uploading a video onto a platform and going so viral that they don't even need to spend on advertising compared to some of their competitors. This is really a hallmark of brand power and a cost advantage for them. The IP is so culturally embedded that it does the marketing itself. Now, pivoting over to the balance sheet, I think we can have an actually really interesting discussion as analysts. The thing that will jump out to everybody is the enormous cash position that Nintendo holds. They have over 2 trillion yen on the balance sheet sitting idle. That's almost 14 billion US dollars worth and is roughly 25% of its market cap. What's interesting, and I think where we can have a discussion, is that for most companies, this would signal a failure of capital allocation, right? If you have all that cash, why are you not investing it back into the business? Do you not have more opportunities to grow? And if not, why are you not returning that cash to shareholders via buybacks or via dividends, depending on how you feel the stock is valued? Good management would recognize this. For Nintendo, though, it's not as straightforward, and it took me some time to figure out. So what I've done here is I've divided the cash by their operating expense every single year for roughly the last 10 years. And what you'll notice is it's actually very stable. It's about 4 and 5 years of cash worth of operating expenses. So in other words, they're very consistent with keeping 4 to 5 years of cash needed to run the business. And if you think about it, that is basically one console cycle. So I think what you can take away here, and we can actually pair with some comments that Nintendo's leadership has said in the past, is that Nintendo likes to take boundary pushing risks with its consoles. If you think about the Nintendo Wii with the remote that you would swing around, that was pretty groundbreaking for the industry. The first Switch was another gamble in terms of the dual form factor that Nintendo used and the fact that that required a very unique trade-off between a powerful device that works on the TV and a light and portable device that people can take games with them. Even though we've seen it be such a massive success, don't forget how big of a risk that really was that they were taking, especially after the Wii U, which was more or less a failure of a console. So Nintendo is risk averse, but they want to be able to take these big swings for home runs, and they don't want to be at risk of needing to take out debt or issue more equity in order to fund a total failure of a console cycle. I think that's what we can take from this strategy. And some other comments that they've said in the past is that if they were reliant on debt or equity, they would have to raise that by announcing their strategic plans to the investor community or the financing community in terms of their banks. And what that would do is essentially kill the hype on their games earlier than they want to, which in the industry, hype is almost this strategic resource that you need to manage in order to optimize the number of sales that a game or console gets. So not having this cash would disrupt that. And then third, they do believe that they get preferential access to their vendors for manufacturing or even for game development because they can guarantee that those vendors will get paid in cash no matter what happens. Whether or not you buy that last one, I think is for the investor to decide, but framing it from this point of view of this cash position representing a full console cycle makes sense in my head. And even though I'm not super excited about it, I do have some forgiveness for it, and I understand the strategy that they're taking. The obvious criticism of it is that it is in every way deeply conservative. There have been really 2 existential crises in Nintendo's past, including the Wii U and the pandemic, and in neither case did Nintendo actually have to draw down that cash. In fact, they just built up a larger cash position. And the real problem is not necessarily that they have this cash. Berkshire Hathaway has a lot of cash sitting idle at the moment as well, but the environment that Nintendo operates in is the Japanese environment, which for the last decade has effectively had 0 interest rates. And even though it has changed in the last couple of years, it's still below 1%. So that $14 billion of cash is effectively earning 0 return for Nintendo. In fact, it's being inflated away. So there is very much an argument that can be made that this is a failure of capital allocation. At the same time, to give them some credit, their reputation as a hoarder of cash is maybe a little bit overblown. If you look at their dividend yield, it's pretty consistently around 50 to even 60% in the last year, which is pretty solid. And I think goes to show that this really is a situation where they're keeping cash for a gaming cycle rather than just hoarding cash for the purpose of it. And then finally, we'll take a look at the cash flow statement, which is really the lie detector for a business. Sometimes the income statement can mislead you and make things look better or worse than they actually are because of foreign exchange differences, which Nintendo is definitely subject to, being a global business but reporting in Japanese yen. So what I've charted out here is the operating cash to net income. In red, you have your operating cash, and then in gray, you have your net income. And the difference between this is where the interesting discussion occurs, because we can see that it was actually pretty tightly correlated until the pandemic. And then since then, there's been this massive gap. And I figured out that it can be explained by 3 key sources. The first is this gap here in FY22 and a smaller but still large gap in FY23. And this is really because FY21 particularly and FY22 to an extent were really blowout years for Nintendo because of the pandemic. and these created massive tax liabilities that they had to pay back in future years. So that is the main reason for the gap in these years. And then in recent years, the gap is mostly due to FX gains. If you think about it, Nintendo's largest demographic is in the United States. So they earn a lot of their money in US dollars, and then they report that in Japanese yen. Now, the Japanese yen has seen a pretty considerable weakening in the last few years, which means that on the income statement, they get to record this massive gain as those dollars are converted into the weaker Japanese yen. But that doesn't hit the cash flow statement, and we get to see that here in the launch year of the Switch. Cash flows were actually really low, which is what we would expect. The third explanation, because they are building inventory for the Switch 2 launch, working capital demands eat up a lot of that cash, and really that component is quite expected and understandable. So I think what we can take away is that Nintendo does have a truly cash generative business, especially in the non-console launching years. And the differences between net income and cash can be explained, and I don't think are necessarily alarming, but need to be understood going forward. So if you found this useful, I think you should subscribe. In the next video, we're going to be looking at the moat and whether or not Nintendo's intellectual property, pricing power, cost advantages, and network effects protect them from a lot of the rising competition in the industry. And you'll probably like this video over here where we go through the entire business model of Nintendo from front to back. So if you like that, please like the video, subscribe, and thank you for watching.